Well, good morning, everyone. Can you hear me okay? If you can, just go ahead and put a quick message in the chat box, or you can raise your hand. And Vita, can you confirm?
Yes, absolutely.
Awesome. Thank you all. I'm Lindsay Roux-Evivar, Vice President of Grants and Business Development here at the Alliance. We're really excited to have you join us today to talk about federal audits, a very, very exciting topic, and thankful that you guys are all have this on your radar because we certainly understand the importance right now with all the federal funding coming down. And so we're excited to have BKD joining us today. So first, I'll cover just a few housekeeping items. So we are recording this session. Everyone's lines will remain muted during the session just to reduce background noise. There is a Q&A tab, so you can submit your questions throughout. Probably what we'll do is wait until the end to go through all of the questions. And if there's anything that we don't have time for, we can always send those on to BKD. And just a reminder, we will be doing a very simple post-training evaluation that we do at the end of all of our trainings. So please do take the time to answer those questions at the end. We'll have it in the chat box, and we'll also be sending it out via email. So I wanted to do a quick reminder here at the beginning, just to make sure we're all on the same page. Obviously, there is the federal funding that has been coming down directly to the health centers, and that will be a focus of today. But we also have here in Arizona several funding streams that have come down through the Department of Health Services, through the Alliance, and is available to all of the health centers. So just as a quick reminder, starting last fall, we got the funding for the testing sites. There is still money available there, although we do project that money to be spent by this June. Then we got funding specifically for vaccine cold storage equipment. We still have plenty of money left in that bucket. And so I just wanted to remind everyone that that is available. So as you're thinking strategically about what do you want to put into your HAF budget, just keep in mind, we already have some funding for some of these items. So please make sure that you're taking advantage of it. If you have any questions, feel free to reach out to me. We want to help you guys to utilize all of this funding. And then the third funding stream is for vaccine administration. It's really the operations of performing vaccine administration. That is funding that the contract is just now being finalized with the state. So there will be information sent out to the health centers soon. But that is $3 million there that's being shared amongst the health centers. So here are the objectives of our presentation today, really a focus on how you need to be prepared for audits, again, because of all the federal funding that is coming down. So we have our experts joining us from BKD. We have Jeff Allen and Catherin Gilpin. Truly, these are the national experts when it comes to everything to do with federal compliance for accounting and just making sure that both your grants and finance departments have all of your policies and procedures in place so that we're audit ready. So with that, I'm going to go ahead and turn it over to BKD.
Well, thank you very much for inviting us here to be here with you today to kind of share some time with you to talk through some of these issues. We're going to kind of put our slides up on the screen. Thank you, Catherin, for doing that. You know, it really is, this is an unprecedented time. It is and by the way, don't be distracted by the massive amount of snow that we're getting behind me in the background. For some reason, on April 20th, it's snowing in Southwest Missouri, which is where we're at, which is very abnormal, but it is coming down in buckets right now at the moment. So anyway, I digress. Anyway, but the thing is that we really have had an unprecedented amount of money that has been given to our industry over the last 14 months. And it really has posed a lot of issues and a lot of questions. We've had more calls and emails in the last 14 months than any 14-month period of our CHC team in the history of our team. There's been a lot of questions that have just, well, can I spend it on that? Can I do this? Can I do that? And a lot of those questions, amazingly so, have been like, well, based on the guidance that exists today, I think so. Here's kind of where it's at. Here's where we're at, with this particular issue now. We're starting to get a little bit more answers occasionally. There's still some things we don't know. some things that we got to work through. But we do know that whenever there's a lot of money that comes out, the audits follow. And I don't know if you remember from 7, 8 years ago when the ARA funds were all distributed, if you've been in the industry long enough to remember that. Remember all those OIG audits that came after that? There was clinics that had to pay back millions of dollars of that money, and it was really scrutinized fairly closely. And so we really want to get that message out now. Man, if you can see that train that's coming down the tracks and you know that it's still a year away and you can get prepared for it now so it doesn't run you over, that's what we really want to do. We want to just start really talking about this now so you can prepare for the future. Catherin is really in charge of our grants management section of BKD for us, for community health centers. And so I'm really excited. She's going to do most of the points today, and I'm going to turn it over to her now. I will come back in a little bit and talk about provider relief funds and some of PRF money or some PPP loan money and some things like that in just a few minutes. But I'm going to let Catherin really just take off with this federal audit of the future, and we'll go from there.
All right, Jeff, thank you very much. All right, with that, we'll start our discussion and let's talk about the federal audit of the future, okay? So we like to start with this slide to scare people, right? Because that's a surefire way to make sure that you're paying attention. Because this was actually an actual letter that many of our health centers received in July of 2019 when the Office of Inspector General for HHS performed audits of health centers' AIM funding, right? So like Jeff mentioned, you know, with every type of funding that's provided, every round of funding, right, there's going to be audits. This specific funding, all of the funding you've currently received actually is, you know, part of the money has already been set aside to do the audits of the future, right? This happens to be the latest audit report that was issued in regards to community health centers. And what we really wanted to do was actually show you, all right, let's say that, you know, if you replace AIMS audit with an audit of ECT grant funds, right? We want to show you what do we think that this audit letter of the future is going to look like, because I think it's actually going to look very similar. I think one of the high risk grant funds that you received is the ECT funding, mainly related to the fact that it had a very narrow purpose and, you know, very similar to AIMS. And if we take a step back and we actually look at the AIMS audit report, so the audit started in July of 2019 and they were performed, or they were finalized in November. If you look at the feedback and if you actually look at the audit report that was provided, here's what it said in summary. 15% on the very first page, here's what it says, right? We gave a lot of money to health centers. And when we look at the results of the audit, about 15% of the funds we determined needed to be returned. If we just make a, you know, generalization that, you know, and look at this latest round of funding, that $6 billion was given to health centers. If we look at approximately 15% of that money getting returned, do you know what the average health center payback would be? Just, you know, 15% of the $6 billion divided by the number of health centers. It's about $650,000, right? Nobody wants to be in a position where they would have to pay that money in the future. It's almost like if you know you're going to make a mistake equal to that, you don't want to set that money aside, right, and not be able to use it. That's why we're having the discussion that we're having today, because we don't want you to have to write a $650,000 check if your health center gets audited. Because you know, there are very many common problems with health center grant funds, and we're going to talk through them, many of them today, right? Jeff mentioned he's going to talk about provider relief funds and the program that never stops changing, PPP. Both of those programs never stop changing, right? But we're going to finish our conversation today with just a discussion about grants management and, you know, some of the important concepts. There's a theme with every audit from ARA to, you know, these AIMS audits that were performed of health centers doing poorly in certain areas. Of the 100 health centers were audited with this AIMS audit, and of the 100, 34 received feedback in regards to one, you know, financial administration related to their grant, and it related to time and effort. So time and effort is one of the largest areas, largest places where health centers are non-compliant. And we've got a section in our grants management section where we're going to talk about that. We have health centers that continue to not pay attention to the grant cost period. And that was very common. trying to allocate expenses to different grants when they're not supposed to, right? So ECT funding should only be supporting testing, but we have health centers potentially trying to allocate accounting expense and administrative expense, right? So we want to, when we have a very restricted grant purpose, we have to honor that and make sure that all of the services, expenses for services we're allocating to that award should be supported by that award. So let's move on and let's actually look at this document request list and let's just talk it through a little bit, right? So what would this look like if it was an audit of ECT funding? And with each of these items, what would they be expecting your health center to provide to support the expenses? So if you look at number 1, summary list of expenditures claimed for the AIMS grant funds. So we're going to talk about this when we go through our grants management principles, but one of the things, a foundation, in grants management is that you've got to track expenses against each award. You have to make sure that all of the expenses are allowable and allocable, right? You should actually track those expenses and you should have a list of those expenses before you make a drawdown. Look at this item number 2, list of staff who worked on the AIMS grant. When we budgeted for all of our grant funds, we specifically identified employees or positions that would be supported with each of the grants. You don't necessarily have to stay with those people, right? But what you should be able to do is identify in your records for each of the grants and all of the funding that you've received, who you allocated to which grant, right? Payroll records for all the personnel on the AIMS grant. So you want to make sure that you have time and attendance records and you have after the fact certifications for time spent. We've actually got an example of what the time and effort reporting looks like that we're going to talk through later in this discussion. Supporting, let's look at number 4, supporting documentation for the types of services you're providing. This is really only relevant related to the ECT funding because it has to be for testing. But one of the things I want to challenge you with related to the ECT funding is what are you doing? We have health centers that had to maybe repurpose some of their dental staff, right? And we had dental staff, performing some other activities related to testing and taking temperatures and things like that at the door. Did you prepare a revised job description so that it said, oh, they're no longer a dental assistant. This person has now been reassigned to the front. Did you, what kind of documentation do you have in writing? It's called contemporaneous support, right? What did you document that said, oh, this person is actually doing something else at the health center now, and they're no longer a dental assistant? That's some of the support that you could provide during an OIG audit. All right, so if we look at this number 5 section, supporting, this was, specific to AIMS funding, but if you look at what it's trying to ask you, basically is supporting documentation for expenditures, right? We have to specifically identify expenditures and we have to have and maintain the appropriate support. One of the things that we're actually going to do is we're going to talk through procurement. A lot of health centers, procurement change, and I actually still work with health centers. Procurement changed in 2014. And Jeff and I are both still working with health centers that don't understand the changes and don't have compliant policies. So we're going to talk that through and we're going to help you to understand what type of support should you be maintaining for procurement. A list of training, this still goes back to procurement and it goes back to the identification of expenses. Now we know you're going to submit the UDS report. That's something that pretty generally gets pulled related to every audit. We also have the quarterly progress reports that are going to get submitted. And, what I think the OIG is going to do when they do audit these grant funds is they're going to look at the quarterly reports. They're going to look at the narratives that you provided, and they're going to try to tie that to the personnel you allocated to the award, to the expenses that you procured, right? And then ultimately to your grant funds in the general ledger. So here, 8, 9, and 10, this is where they're going to try to identify if you need to pay something back. They're going to ask you for a list of the drawdowns. When they ask for the list of the drawdowns, what are they going to try to do? They're going to take your drawdown of $50,000. They're going to make sure you followed cash management standards because, another basic principle is you should write a check before you draw down your federal grant funds. If you write a check, it had to be for an allowable expense that you procured, right? So we're just going to remind you during that grants management section of our discussion today of rules you need to follow. So they're going to ask for the general ledger transactions. You should be tracking revenues and expenses in the general ledger. It's actually a requirement in the Uniform Grants Guidance. They're going to pull your bank statements because they want to look and see when your checks cleared the bank, because you shouldn't have drawn down the grant funds until your checks cleared the bank, right? And then one of the things they're going to do is ask you for reconciliations between your drawdowns and expenditures. And so I've actually kind of got an example slide of a reconciliation that you might be able to use. And, make sure that you can use that example slide to challenge your own reconciliations that you're doing on a monthly basis, because you should be looking at what you budgeted and making sure that it agrees back to your actual expenditure. So we're going to talk that through with the grants management section, but I'm going to turn it back over to Jeff for it, so that he can actually talk about update on provider relief funds and then also the PPP program.
Sorry about that. I couldn't find for some reason, I couldn't find the button. I was like trying to find my video button. I couldn't, so I apologize. Yeah, so we are going to talk a little bit about provider relief funds, and we could spend the whole hour talking about provider relief funds and exactly how this all works and do that. We're just going to kind of provide an update. Some of you have been on our webinars that we've done nationally. We did a town hall meeting with NAC, a few months ago that went out to everyone. So let's move on to the next slide, please, Kat. But anyway, if you look at really the terms and conditions of where they're at, we had these funds that were just kind of showed up almost in our bank account. And at the time, if you really read through the terms and conditions of accepting this money, because you had to go and officially accept the money, accept the terms of it and how it worked. It said that these funds that are hitting your bank account have to be used to prevent, prepare for, and respond to the coronavirus, and shall reimburse you for healthcare related expenses or lost revenues attributed to the coronavirus. So that's really all we got. We didn't get a whole lot of information right then. That's pretty loose. I mean, there's a lot of things that you did to prepare for COVID. There's a lot of things that you did to get your clinics ready or get staffing issues or keep people employed. I mean, you could make the case that a lot of things fall into that category, but it was pretty loose. And then all of a sudden we kind of started getting other information that came out, and all this stuff that had to be attested to, and new FAQs that came out. And so it really changed from there. Let's move on to the next slide, please. All right, so all of a sudden, about May 6th, well, this is when they first published it, but HHS started getting a ton of questions. People reached out to them and said, well, what is about this? What about that? And even for health centers, some of health centers got a few $1 million, some got a few $100,000. It was really all over. It was based on a couple different factors, your Medicare fee-for-service revenue, and there was a rural allocation and distribution, and we won't go through all that. But so it varies quite a bit. But in a lot of cases, hospitals were getting $25, $30 million for some of this, especially some that were hit pretty hard. They were building COVID units. They were actually bricks and mortar onto their building. And they were asking all kinds of questions. This is okay to expense to the coronavirus, to the COVID relief? Is it okay to use my provider relief funds on this? And so they started issuing these FAQs. Unfortunately, and it is when you issue multiple FAQs, and they just released some just a couple weeks ago. So it's actually been very ongoing from May 6th all the way through now. And I don't see that changing, at least in the next few months. We keep getting little updates. They keep asking questions. To them, from their perspective, it's clarifications. We're just giving clarifications. We're making sure that you understand the rules. And in some cases, they really give conflicting guidance. In some cases, they've given things that really almost lead to more questions. And they're, to be fair to them, there is a lot of complexity to this. There are a lot of moving parts. Not everybody spends the money the same way. So but anyway, they haven't really helped themselves a whole lot with some of these. So they came out with some post-payment notices. Those came out September and October. The last one was in January. We have not had a post-payment notice since then, since January 15th, at least as of 11 o'clock Pacific time today. We've not had that happen. So anyway, we are really at this point sharing the rules that are in existence as of now. Those certainly can change in a little bit. Let's move on, just one more. All right, so here's a copy of the FAQs. I would definitely, if you are a health center CFO, if you're responsible for that, it doesn't have to be weekly. You could probably do it twice a month. Just go out to the HHS website. You can literally Google it or whatever search engine you use, and and type it in and you can get right there. Just go check in the FAQs, maybe a couple times a month. Maybe if you want to do it weekly, you can. They usually issue them on Friday. I just kind of had a tendency to do that. Go out there and look at them because they really do give information out there. And sometimes they'll answer the specific question that you might have on provider relief funds that they have. And of course, we're always looking for more guidance on this to see if there's going to be more changes to that. Let's move one more. All right, so where we are today, we still have what we call a two-step approach. So you still look at your expenses first. You look at your expenses first. Then, if you don't have expenses that do not have another source, that's been the big thing with CHCs. It's been a trip up. We've got 340B savings. We've got patient revenue. We've got all these other sources. And so in a lot of cases, you don't have expenses that don't have another source. And so it's been really challenging for a lot of health centers to say, well, I guess I could have used program income to buy that PPE or to do this or purchase this particular, piece of equipment or whatever it might be. And so, sometimes we run out of expenses. We don't have enough that. And now we've got HHF money. It's hard to say real quickly. We've got that funding stream that's just about ready to hit. We've got, we've just had a lot of different stimulus packages that makes it the expense side a little difficult for most health centers. So if we can't get to that, and you might be able to obligate a little bit, but maybe you can't obligate all of it, but whatever you have left, whether it's 100% of it or it's 50% or whatever, you can then go to lost revenues. And now the lost revenues are in 3 different categories. Okay, you could just do a simple comparison between 2019 and 2020 actual patient service revenue. There is some thoughts about whether the 330 grant counts, whether 340B counts, all this stuff. Right now, until they clarify it more, I know some people have taken different approaches. I'm telling my clients to look at patient service revenue, which would include 340B in that. They may change that again. We don't know for sure what's going to come out into the future, but look at the 2019 and 20 actual revenue from patient service revenue standpoint and look to see if it had a drop in 20 versus 19. That's step A on the lost revenue. So if you had $10 million of patient service revenue in 19 and it dropped to 9 million in 20, that's a pretty safe, simple, straightforward, as of the rules stand today, that you could be able to obligate $1 million of provider relief funds using lost revenue. So the second one is we could look at budgeted revenue. Now there's some timing on that. The budget had to be approved by, I think it was March 25th. There's a date there in March that had to be approved by. You had to have clearly a defined budget. You had to be able to show the budget. You have to be able to show your work, show how you did it. But if let's say you did 10 million last year, but this year you budgeted 12 because maybe you opened the new site, maybe you had something going on and you only hit 11. And so you could really document and show that budget based on what we actually did is $1 million different. That might be a way that you could obligate provider relief funds showing lost revenues. And then the last one is a catch-all. It's really what I put on the slide there is any reasonable method. So anyway, who knows what that's going to be? Maybe that's going to be a health center that opened up a brand new clinic in January of 20. Therefore, 20 and 19 aren't comparable. If you look at my audited expense or patient service revenue or my internal financial statements, if you're not a 12/31 year in, and you look at my calendar year 20 versus 19, and my 20 went up a little bit, but it's only because I opened up this new site. Could that be a number 3 possibility? I'm going to exclude the new site for purposes of comparisons and show my lost revenue calculation that way. Now the HHS has said that if you use number 3, if you come up with some hybrid approach to this, it is a much more likelihood of audit. I mean, literally picking it apart and looking at it on their end versus the other 2 methods. So you have to make sure you go that road. I honestly believe probably at the end of the day, when the dust settles and the smoke clears, there are gonna be a lot of people use number 3 because I think there's a lot of different factors involved. There's a lot of different issues going on with those first 2. Occasionally there's different factors. Sometimes we really lost ourselves completely in that second quarter of the calendar quarter, but maybe third and fourth quarter, you came back with gangbusters and you ended up the year about even. Could you have another method to say, hey, look, in this quarter alone, we lost this amount of money and show that as a number 3? I think that might be a possibility. So anyway, there's no way we could run through all the different possibilities for the number 3, But the thing is, that's a possibility there. That is a things to think about as you go through there. Capital purchase inventory attributable to coronavirus are allowed. That's been gone back and forth a couple of different times. Now it looks like there are. So that hospital that built on that wing just simply for the COVID ICU patients, that gives them a lot of comfort that they can actually use that for provider relief funds for that. And of course, we may have PPE, we may have other equipment, we might have some typical, ventilator equipment or something we might have bought for that. Those purchases are allowable, and G&A could be used as well. Let's move on a little bit. All right, so here's the where we are as far as reporting. February 15th, which is, in CHC world is UDS Day. We know that day well in our industry. But February 15th, they said, okay, we're going to open up this portal. You're going to be able to enter in information in the portal. You're going to be able to show what you've obligated from provider relief funds. We're going to have some reporting requirements in that portal. We're going to open it up and it's going to be ready to go. Well, we're still waiting. They have put out they've postponed it indefinitely. So there is not a new due date. It's not May 15th now. It's not June 15th. We don't know when it's going to be. So there's all kinds of rumors going around and we could speculate all day on it, but nobody knows really when this portal is going to open up. And when it does open up, that will hopefully, it should answer a lot of questions about how we can spend and what we can spend money on. All right, let's move on to the next slide, please. All right, so there are a lot of, as far as expenses are concerned, I'm not going to spend a whole lot of time going through all the different expenses that are there. There's different entity levels and stuff. They've said that, hey, if you're going to be less than this, you want to be one of two categories. If you're over this, you got to report expenses in detail. There's a little bit more work to do to show what you spend it on. But these are for expenses that don't have another source, but yet you're saying you're using provider relief funds on. And then the next slide talks about the lost revenues. So you're going to have lost revenues attributable to one of these three. If you go to the next slide, please. Thank you very much. So lost revenues is you can look at your payer mix, your calendar year by quarter, look at all these different things. You're going to factor in all these things into this calculation. You really are looking at total revenue or net charges, obviously net of contractuals, net of bad debts from patient care related sources. So that is, we could spend the next 30 minutes talking about what does patient care related sources mean. And that is one thing where I'm really wanting some clarifications more from HHS. There is one FAQ that leads us to believe that maybe 340B doesn't count. And then there's one FAQ that clearly says 340B is included. So what is that? We don't know yet. Is the grant really a revenue that's related to patient care? Well, those of us that are grant purists say, no, the grant is really for expenses. I mean, we have expenses. We document our expenses that we charge to the grant. We don't really, it's not for patient care. But, is it really for sliding fees so that our self-pay patients that we can pay, we can have that sliding fee discount program? So there's all kinds of differences of thought on that. So those are still yet to be determined. Next slide, please. All right, so here's just a really quick recap of those three areas. I won't spend any time, I've already covered all those, but those are the three. You just have this in your slide so that you have this later to refer to. Those are your three buckets of how what you can document for lost revenues. And I think probably most health centers are going to end up going the lost revenue route on this. All right, next slide. All right, so there is an extension of the time period, as you can see here on the slide. If you didn't find a way to expend those provider relief funds before 12/31/20, you have the option to really look at moving it to June 30 of 21. And it also gives you a little bit, of ability to kind of look at it quarter by quarter. So maybe in 2021 to compare it to the prior quarter and do some comparisons there. You can read that. You don't need me to read it for you, but there is some little bit of level. You at least have an extension through June 30. The question that I have that I would love to have an answer for is there going to be an extension past June 30? Are we going to have another? Are they going to put it to 12/31 now? Or are they going to put it out another year from June 30? I don't know the answer to that yet. It wouldn't surprise me to see there be another extension, but right now we're a little over 2 months till that final deadline. All right, next slide. All right, so for the accounting for this, not to get into really deep things on accounting for provider relief funds, but it is what we call a non-exchange transaction. And I don't know of any firm out there that says it's exchange, so I think everybody agrees on that. So it's really what we would call a contribution, but it's a restricted contribution. It's a, it has some restrictions on it. So in order to recognize the revenue that you have on that, you have to satisfy the restriction. So you get this money in, it's a restricted contribution. You want to record the liability immediately upon getting that cash. And then as that restriction goes away, as you spend the money, or you clearly can define that you've got lost revenues, you can document that, then you can take that restriction off and recognize it into revenue as a patient-related revenue, or as a contribution, excuse me, not patient revenue, as a contribution revenue on your financial statements. All right, next slide, please. All right, so one thing that we have that I think we need to cover just for a minute is that there is new guidance out there, as we talked about. They've had new reporting requirements or new, those 3 times they've issued those requirements that have been different. They have changed rules. They have said, hey, this expense is okay, and then they came back later and said it's not. There has been, well, you can calculate things this way when that wasn't allowed before. And so there's been some real changes. So in accounting terms, and this is really an audit issue, not an accounting issue, but an audit issue, if you look at it, topic 855, you have what's called 2 different types of subsequent events. A type 1 subsequent event is just really a clarification, or maybe it's something that's just, it's clarifying existing guidance that's in place. Type 2 subsequent event is entirely new guidance that's issued. So it is possible that you might have a June 30, 20 financial statement, maybe for your auditors, where you've actually recognized provider relief funds, but then something happened in September and October that changed the rules. Well, believe it or not, that doesn't change the accounting at June 30, 20 if it's a type 2 subsequent event. That type 2 subsequent event is from that point forward accounted for that way. So it is possible, we've actually had a few at BKD where we have a June 30 financial statement and we have provider relief funds on the recognized in the revenue in the financial statements. And we've already told the board of directors, hey, by the way, you're going to have to reverse that next year unless they change the rules. Because the way they've got the structure, now that expense that you made is no longer a covered expense. Or the lost revenue calculation that you did back in June that was allowable back then is no longer allowable now. And so you've just got to understand that that's the case. That's the accounting of it. It's really kind of complicated. I can count on one hand in 27 years we've had type of subsequent events in the health center world. It just doesn't happen all that often. All right, next slide, please. So, qualifying the expenditures, revenue recognized, expenses are incurred, making sure you don't double dip. Catherine's going to talk about that, I'm sure, about double dipping and things like that. You can't spend grant money over the salary cap. Remember that. That doesn't mean you can't use your program income to cover people over the salary cap, but you cannot use federal grant money for that. You have to make sure that you're not doing that. There's some restrictions, certainly on lost revenues. That last thing, I think that, one thing that BKD has done is reached out to a lot of other firms our size and said, hey, how are you doing this? We don't want to be out on a limb. We don't want to be doing one thing and everybody else is doing another thing. I mean, you want to kind of compare notes. So we have done that, but that doesn't mean that every auditor is on the same page on this. So you want to reach out and say, hey, what's your take on these provider relief funds? What's your take on and recognizing lost revenues right now? How's that going to work? That's a really good discussion to have with your firm to make sure that you are on the same page there. Because the last thing you want to do is recognize a bunch of stuff, show your board these financial statements with $1 million of provider relief funds recognized as contribution revenue, and then now it's off the table. All right, next slide. Okay, so real fast, I want to get it back to Catherin. She's still got several things to cover, but I want to know what the deadline is reporting is. Those are questions I still have. I want to know exactly if there's some alternate things on the budgets they're going to be willing to prepare. Is there going to be an alternate? What kinds of alternate methodologies is HRSA going to be, or HHS going to be okay with on lost revenues? These are all big questions I have. Actually, we could talk the next 20 minutes about all the questions, but these are just some of the main ones I have. All right, next slide. All right, real fast with one slide on this other stimulus funding. Let's just talk about it for a few minutes. The $7.6 billion that health centers received for new stimulus funding is the largest amount of money ever given to health centers, the largest ever. So it is going to be really tricky how we manage all this and juggle all these different funds and make sure we don't double dip, make sure we spend it the right way. Accounting departments were already stressed out before this new money hit. Now it's even going to be more than that. So we just need to understand this is a big deal. We've got, we PPP loans, a new round of those, even for the bigger entities that can get them. We've just got a lot of moving parts. We could have another session just about PPP loans and the accounting for that. But it's just important to really understand it's really important right now for you to really dive deep into your general ledger, your accounting records, and making sure that this funding is all accounted for, separated out, clearly identified what expenses go with what, and make sure that you can stand up to scrutiny that certainly is coming down the road. All right, Catherin.
All right, so let's start talking about grants management. Thank you, Jeff. Let's talk about, Jeff already kind of touched on this, right? Double dipping. Double dipping is one of the very biggest risks related to this funding. I wanted to actually give an example. Well, first, this slide, we've been using it all year, and we don't apologize because it's so darn funny, right? When we started using it, I actually was working on this presentation, and my daughter came in and she's like, "What is this?" And I told her about this episode, and she's like, "You can't do that. You can't dip the chip twice," right? Even my 10-year-old, got the concept of you have to be very careful with all of these flexible funding streams, right? We want to make sure, foundation of grants management is you have one expense, it only gets charged one place. Some of these, one of the biggest challenges related to the provider relief funds and then also PPP is that, we don't know, because we're still kind of in limbo with provider relief funds. There's always been a question in the back of everyone's mind that can you obligate federal money without an expense, right? So Jeff talked you through those two examples, and he said, first you have expenses, right? It's real easy to not double dip. If I put an expense towards provider relief funds, I'm not going to put it to one of my grants. But what about lost revenue? Like, do I still need to step back and make sure that I've got a pool of expenses to support the lost revenue calculation? We've always wondered that, and we continue to think that with the issuance of the compliance supplement and with the issuance of additional, post-payment guidance and FAQs, that would be a question that would get answered. And it hasn't necessarily. Right now, it doesn't seem to be the biggest concern that we're going to need expenses for lost revenue, but it was certainly a consideration. Same thing with PPP. There's always a strategy, right? That, PPP loans, the paycheck protection loans, that's salary and wage expense for the most part, right? One of the strategies that we've been telling all of our health centers is maximize the 40% of the other expenses. If you haven't submitted your application, think that through and make sure that you include expenses up to that 40% if you absolutely can. That way we have our pool of expenses, the salary and wage expense, available to allocate to some of the other awards that it's easier to allocate them to. So there's certainly a strategy that you've got to think through. One of the things that I've been telling, every CFO, every management team that I talk to at health centers, and I know Jeff is having the same conversation, is you got to continue to be strategic and intentional. Jeff mentioned it, but I'm gonna say it again because it's so important. Keep making sure that you are making yourself aware of changes in the guidance, especially related to provider relief funds, because I'd hate to see you get into a situation where you have to pay some money back because you just weren't paying attention to the guidance. One other thing I want to mention about provider relief funds is one of the common questions we're getting is also strategy, right? How can I spend my provider relief funds if I don't think right now, when I look through my expenses related to COVID and I look through my lost revenue, how could I possibly, spend those? There are some strategies that, I think you could employ. Jeff and I have been talking to our clients about, retention payments to employees. We've been talking through, hero pay, hazard pay consideration. There's certainly a grants management component to hazard pay. You need to have a policy. You can absolutely charge it to one of your COVID awards that you received from HRSA, but that's also easy money to allocate to potentially the provider relief funds. You have to make sure you didn't get reimbursed from another source. And Jeff or Lindsay could answer if there's cost-based reimbursement in the state of Arizona. And so, Jeff, what do you think?
Well, no, Arizona rebases their rates every 3 years, but they're on a pure PPS rate. So yeah, if the health center has a bump in expense, it wouldn't increase their rate.
Okay, yeah. So, I mean, if you make a hero payment, that might be something, or a hero payment, a hazard payment, a retention payment. Those are payments that could potentially dollar for dollar be used to obligate provider relief funds if your health center is in a situation where you don't think you've spent all the money from a COVID incremental expense standpoint, or one of the 3 lost revenue scenarios that Jeff talked through. All right, so we've been saying since last March, when we all became aware of COVID and money started getting sent to and provided to our community health centers, that the high risk is the tracking, right? You want to make sure that you're not allocating one expense to more than one funding streams. Inadequate records to support the administrative requirements related to grant funding. The next slide, we're actually going to talk through some of those administrative requirements that we think are the most important, where health centers tend to do poorly based on audits of ARA funds and then audits of even the Ames funds that we started this presentation discussing. Programmatic performance, that is all up the ECT funding, that's testing. You can only use the testing money for testing, and OIG auditors are going to test that. So when we think about the future audits, we know that they're going to happen from the OIG. We know that HRSA's Division of Financial Integrity is going to perform some audits. I've actually been talking to lookalikes that, one of the things that Division of Financial Integrity does frequently for health centers, but the lookalikes are actually experiencing, because, they received their first round of grant funding, is the Division of Financial Integrity actually will perform audits of health center policies, right? Mainly related to the fact that if you get, $5 of grant funds, maybe, if you get $100 of grant funds, right, that it's the same rules as if you get $1 million of grant funds. It's not like there's an easy button, and that the grants management principles are in any way changed based off of the amount of grant money you received. It's, if you accept grant money, you accept the rules related to the grant funds. And so the Division of Financial Integrity has already actually started reaching out to lookalikes that received the ECT funding, and they're actually doing targeted audits of policies. If you ever wanted to see the document that they are using, you're welcome to reach out to us. Our Jeff and my contact information is in these slides, and I can actually send you the audit document. There are 18 key control areas that the Division of Financial Integrity will work through, and they will actually use this document to make sure that they're analyzing your policies, because they want to make sure that you have the right policy language in place. And, at least on paper, what you're supposed to be doing with your grant money. When the OIG auditors come into your health center, or your financial statement auditors, one of the things that they're going to do is, they're going to look at your policies, and they're going to make sure your policy is compliant, right, with the grants management standards. But then, the second step as part of the testing is they're going to make sure that you're following your policy. So it's important to have the right policy language in place, but then it's, second step is have procedures, right, that support the policies, and you have to be following your policies. So the next couple of slides, what we're going to do is actually talk about what are some of the most important grant management principles. All right, we're going to start with a talk about budgeting. We're going to jump right into administrative records, right, the financial management. This is what your record should look like. We're going to talk through carryover request and the no cost extension. And then we're going to end our discussion with the time and effort in procurement, because that's always where everybody has problems. And so we want to focus most of our time in that area. We've included some information within, the next, 15 slides that some of it we're going to go through a little bit quickly, but we've included that so that when you receive these slides from the presentation, if there's something that you want to look at so that you can compare it to your own process that's in place at your health center, you'll have the information in the slides to be able to do that. So if we move on and we actually begin to talk about the budget, one of the things that I always like to remind our health centers, and I left this slide in where we had actually been taking it out of presentations in the past because you just received your H8F funding, right? That grant budget is due May the 30th. And so what I wanted to just mention, right, this is what we tell every health center, all right? So I've reached out to HRSA. I actually did this last week. And I asked them about program income. It was something that I didn't hear that they addressed during the FAQ call with Jim McCrae, where he was talking about the funding. HRSA mentioned that health centers don't necessarily have to budget program income with this funding, so that's very helpful. One of the things that we tell every health center, though, is that when you're looking at the different lines that you can budget, when you're preparing your budget justification, you have to make sure that you budget on, or it's a best practice, you don't have to do this, you know, you could use one line item of the budget. We encourage you to budget on every line of the budget, because if you don't budget on every line of the budget, and if you put 0, let's say on the fringe benefit expense line, you're not actually able to allocate any fringe benefit expense to the federal grant, to the H8F funding, right? So you want to make sure that you put some amount of expense on every single line, so that if you do need, you know, when you're strategically thinking about which expenses to allocate to that award, it provides every health center with some flexibility. I also want to just remind everyone that related to the thresholds of this funding, right? So we had H8C, and they were smaller awards. H8D were big. The ECT funding went down. Some of our health centers, especially with the C and the E funding, received less than $250,000. That's actually a different rebudgeting threshold than our 330 grant or potentially the H8D. So one of the things I've been challenging our health centers with is to look at your policy and make sure that, you know, your policy just doesn't reference the standard language in the 330 grant, because you actually have potentially more than one rebudgeting threshold currently. Remember that all HRSA budgets are required to get a board approved, so that if, you know, after you, or actually before you submit them to HRSA as a best practice, you should make sure that you run them through your board of directors. If any way possible, if your health center financial system is, you know, capable of allowing you to import the budgets for the different grants, that's always going to be the best, right? And so, and it would allow you to do some of the automated reporting, because one of the things that HRSA would check potentially when they come on site for an OSV in the future is they want to check and make sure you're doing a budget to actual analysis for each of your grants. And, you know, one of the reasons that you have to do this is because your responsibility when receiving grant funds is to make sure that if you hit a rebudgeting threshold, that you recognize that and you do what is required to rebudget the funds. So this slide, one of the things that we're trying to point out, right, is, you know, this is in essence a budget to actual. If you look at this total award column, what we're trying to point out with the total award is that, and it's actually in this column, right, the total award is, we're saying, all right, this is how much you received and this is how you originally budgeted it. Always remember that if you budgeted for an employee that left, right, that you have to pick a new allowable employee, whether it's your 330 grant or your ECT grant. Remember that, just like Jeff mentioned, you can't charge expense for salary and wage over the salary cap, and you can't charge anyone to one of your HRSA awards if they're charged somewhere else. We've got some examples right here to say, all right, if I didn't budget for unemployment, can I allocate unemployment? We're saying that this is yes. And why? Because what matters is the total fringe benefit line. But when you come down and look at this example, if you didn't budget anything for conference expense and you tried to allocate expense for conferences, it's not okay, because you weren't approved and you need to go through the administrative task of rebudgeting. One of the things we're trying to point out here is that this total award is 174. If the rebudgeting threshold is 43,000, right, 25% of the award, you can actually see that this health center budgeted $500 and tried to allocate $50,000. They have a line item deviation of greater than the 25%, and this would trigger when you need to potentially rebudget an award, right? So there was flexibility with your the COVID awards, right? You could rebudget without asking for permission, so long as you weren't trying to rebudget to equipment or potentially the construction line, right? Why is that? Because when you put things on the equipment line or you put things on a construction line, there's a whole lot of paperwork you need to submit that needs to get approved by HRSA. And so you cannot rebudget to those 2 lines without without asking for formal permission through your grants management specialist or project officer. This is just a maybe potentially easier to read example showing when you might potentially have to rebudget. And so this is saying, all right, total 25% of the budget, you'd have to have rebudgeted at 45. If you have a variance to the budget of greater than your deviation, you need to rework administratively your records. It's far more common right now for health centers to potentially be in a situation where they have to rebudget their 330 grant and not maybe necessarily one of the COVID awards. And so one of the things you might have to do is submit a 330 grant rebudget so that you could have obligated all of your 330 grant. And if you're in a position where you have to do that, this is an example of how the information that you'd potentially have to submit to your grants management specialist. All right, so let's actually move on and let's actually talk through financial management standards and potentially what your financial system should look like, right? So here's some language from the Uniform Grants Guidance, and what does it say? When you're looking at standards for financial and program management, grantees are required to identify in their accounts all federal awards received and expended and the federal programs under which they were received, right? So what does that mean to you? That means, when I interpret this, that means HRSA expects you to record revenue and expenses in your general ledger. Now, I have 2 comments to that, right? I want to tell you about results of ARA funding. Like, why is this the financial management requirement? Like, why can't we export information to Excel and track that information in Excel? Well, if you actually look to the feedback that was provided to health centers when OIG looked at ARA funds, pretty much what they always said was Excel is prone to error, right? So first off, the Uniform Grants Guidance says you have to track revenues and expenses in your accounts. But why do we think Excel is potentially problematic? We think it's problematic because it doesn't have controls in place. It doesn't have the appropriate potentially controls in place. Because if I want to allocate Jeff Allen's salary expense to the H8C and the H8D grant, and I'm at a health center, and I use Excel, it's really easy for me to charge his salary for more than one grant, right? But if I look at the controls that are inherent in a general ledger accounting system, right, it's really hard for me to debit Jeff Allen's expense to 2 different grants because that's just not the way accounting works. So, ultimately, the best control that you can have in place is to make it so that your revenue and expenses equal in the general ledger. Because what do you know if you have salary and wage expense to a specific grant? You know that expense isn't available for another, purpose, right? And so always remember that tracking in your GL and your chart of accounts is the very best. Now, I know that there are different software packages out there and they perform at different levels, right? So we have health centers with QuickBooks, we have health centers with Peachtree, we have health centers with Intact, Blackbaud, Great Plains, right? Some of them have segmented chart of accounts, right? Some of them, like QuickBooks, have classes in the general ledger software. We would encourage you to, utilize the functionality of whatever software package you're using. HRSA, the Uniform Grants Guidance doesn't say you got to get rid of QuickBooks, but it does present with challenges in regards to grant tracking. Like it's meant to track more simplistic financial information and not the most complex financial information. One of the things I've been challenging some of my health centers with, just to think through is maybe if I'm using QuickBooks or another software package at that level that doesn't have some of the grant tracking functionality, maybe right now you might be in a financial position where you can make an investment in some financial tracking software that'll be beneficial that'll serve your organization in the future and meet the current needs, right? Maybe you want to upgrade to something where you can import 15 different grant budgets into your general ledger software so that you can automate the budget to actual analysis, right? I tell health centers that one of the very best things that they can do when they are tracking information in the general ledger is to make sure that their tracking is working. They should have a control in place that says, all right, if I've got revenue of 500,000, I have expenses of 500,000. I should be able to generate a income statement by grant that shows that the revenue and expenses in the general ledger equal. And if they don't, then I start talking to that health center about the identification, you know, what are they doing? And we talk about risk, and then we figure out how we can fix it, right? And so that's one of the very best controls, I think, that a health center can put in place. Accurate, current, and complete disclosure of financial results of each federal award. Absolutely, that's important. Records that identify the source and applications of funds. So you should have a funding segment for HHC, D, E. If you've got expenses towards provider relief funds, you should have a funding segment for provider relief funds. You should actually have a funding segment. When I talk through segmented chart of accounts, something that I think some of my health centers forget is that if it's not grant funded, what is it funded? It's funded from program income, or it's funded from, you know, unrestricted contributions or stuff like that. Like those are other segments I would expect almost everybody has. All right, so how are we going to track information? Just remember that I know that, and you know, I'm guilty when I make this statement, right? We accountants love Excel, and we think it's wonderful, but always remember that we need to, the best control is reconcile our Excel workbook back to the general ledger and make sure that anything that we do in Excel is supporting the information in the general ledger, but we aren't trying to create Excel workbooks that are a substitute for the information in the general ledger. Now, so just remember that you can track information in the practice management system. Some of the things that I actually think can get tracked in the practice management system that I'm going to talk about with the time and effort relates to services, maybe related to testing, right? And so I think you can have some supporting reports out of the practice management system, but it ultimately needs to reconcile to the general ledger. Always remember, if you didn't document it, it didn't happen. You can absolutely have electronic documentation, but when anyone comes and they ask for that list of expenditures for any of your grants, you should be able to say, all right, I drew down 50,000. Here was the checks I wrote. Here are the invoices, and here was my procurement support. All right, so our next slide, on this slide, we're actually talking about payment, right? And this is important because remember, one of those requested items that, you know, I think is going to get asked when OIG is doing audits, probably maybe next summer, right, is they're going to reconcile your cash drawdowns to your cash disbursements, right? That's what's known as payments. And payments, when you're looking at the rules, Uniform Grants Guidance, payment methods must minimize the time elapsing between the transfer of funds from the United States Treasury, and in plain language, that means when you draw it down to when you write a check, right? So the rule has been in the past, you should not draw down the grant funds more than 3 days before you write the check, right? Because maybe you want that money in your bank account before you write the check, but 3 days has been the standard rule. You should make sure that you have your time and effort and potentially your procurement best practice in place before you make that drawdown. You can draw down based off of a budget and then true it up later, but that's so very hard. And so many health centers try to draw down based off of a budget and then they don't ever do the records reconciliation. And so I would just say, as a best practice, I like to tell my health centers, you know, if you don't know what you spent now, I mean, it's going to be hard for you to try to reconcile those records in the future. And so make sure you're doing that. Always remember, federal funds have to be drawn into interest-bearing accounts, and those accounts have to be FDIC insured, and you should have that in a policy. Always, I continue to talk to health centers. Everybody tells me that they're doing this, and I can actually tell you that I was talking to a health center last week, and I was looking at their drawdowns related to some of the CARES Act funds, and I saw a $50,000 expense, and I said, all right, what did you spend this money on? And they said, well, I first asked them, do you have any advanced drawdowns? And they said, no. And I said, all right, so how did you spend this money? And they said, well, I haven't spent it yet. I'm going to spend it on this. And I just reminded them that that is the definition of an advanced drawdown. They told me they didn't have an advanced drawdown, but you have to have the invoice and you have to write a check before you draw it down. So I still like to just remind our health centers that that is important. So I want a big reminder about equipment records, right? So your H8D funds, potentially H8F funds, and the future funds that you're going to receive related to capital improvement, they are federally funded. So when there's different rules that you have to think through with your property when you're spending federal grant money, and when you spend federal grant money on property in your fixed asset records, what do you have to do? If I bought a mobile unit, when your auditor, when Jeff Allen asks you, when he's doing your financial statement audit, he looks at your fixed asset records, he's going to need to be able to see that in the description of the mobile unit that you set up, that it says federally funded, H8D, right? You have to identify federally funded fixed assets in your fixed asset listing. And then you have to identify the percent that something is federal funded. So maybe you purchased a mobile unit and maybe it was 30% federally funded and 70% with program income. You have to identify federally funded H8D, 30% of the total. Why is this important? It's important for really two purposes. And that is because you have to, when you have federally funded fixed assets, one of the things you have to make sure of is that you're doing an inventory every 2 years. And you have to make sure that you are, setting eyes on each of your federally funded fixed assets at a minimum every 2 years. A best practice is every year, at least annually, but at a minimum, you have to maintain the support to have looked at them every year or every other year. One of the other reasons that this is so important, documenting that federal share, is it's related to indirect health centers or any federal grantee that has a negotiated indirect cost rate agreement. Because one of the things that you actually have to do when you're negotiating an indirect cost rate agreement is you actually have to pull out depreciation expense for federally funded fixed assets, because the government doesn't want you to charge depreciation expense and negotiate it into an indirect cost rate agreement, and when they've already paid for the asset up front, right? So if you don't have the federally funded fixed assets earmarked in your records, you're not going to be able to identify the assets you should inventory and the expenses you should exclude. Now, we don't necessarily have a slide about indirect expenses in this discussion, but one of the things that I want to mention that I think is important is, I had 4 calls yesterday with health centers that want to either negotiate a rate, an indirect cost rate, or they want to use the de minimis rate, which is that 10% that the Uniform Grants Guidance allows you to use. And what I keep reminding health centers, when they begin to talk about that 10% indirect rate, right? So if you're thinking about your H8F fund and you just got $6 million, and you notice that indirect cost line at the very bottom of the budget justification, you're like, man, it would be really easy if I put 500 or 5 million of direct expenses and then I just applied 10% and bumped that, right? One of the things I just keep telling people and reminding them is that when you use an indirect cost rate, whether it's the de minimis rate or a rate you negotiate, you have to negotiate an indirect cost rate with this department of HHS that's called Cost Allocation Services. And you have to do that annually, and it has to agree to your audit. And it's something that you have to do every year, or you only are allowed to use the 10%. once you start using that 10% or the negotiated rate, you have to use it consistently to ask any federal grant for a reimbursement of indirect expense. So you can't say use 10% on your H8F, the de minimis rate, and then continue to directly allocate indirect expenses to the 330 grant, because that's where you get into a situation with indirect expenses and potentially double dipping, okay? Because you've already asked for 10% through the H8F. You have to be consistent in how you're applying indirect expenses. If you want to charge an indirect cost to the ECT funding, you had to have a negotiated rate. You couldn't directly allocate it, right? But if you use 10% on the ECT grant, you have to use 10% on your 330 grant if you want that grant to reimburse indirect expenses. So, please do some research to make sure that you don't get into any trouble if indirect cost rates is something that your organization potentially wants to begin to utilize, because you can't just pick one grant. You have to be consistent when you're allocating expenses to awards. And the 330 grant allows a lot of flexibility with indirect expenses that other grants don't. So this next slide is actually talking about notice of federal interest. And when I think through the notice of federal interest, one of the things that I received a question last week, and I had not received this question before, and I was actually surprised by it, okay? So many of you probably right now are having the same kind of question that my client had. And we've never really had to file this form SF428, right? Or this SF428B. But what is it? It's a notice of federal interest. So every single health center that received like H8C funds, there's a task, well, all of the COVID awards. So there's actually a task related to each of your grants currently sitting in EHB that says, oh, don't forget, within 90 days of the end of that grant, you have to submit this form. And when I had thought about federal interest in the past, I'd thought about it only for my property purchases, right? Over $5,000 useful life greater than a year. What I hadn't actually thought through was that this form actually covers supply potentially as well. And if you think about the CARES Act funding, it was given its own project period. And we have to report on the project period that says we don't have a residual inventory of supplies that we're not going to be able to use, right? It actually tricked up this health center because they were like, I absolutely still have supplies on hand. And I don't want to report to HRSA that I have a residual inventory of unused supplies at the end of my H8C grant period, because the form implies that you have to pay that back. And that's absolutely not the case. And so when you look at that 428B, just always remember that the federal interest rules, especially when talking about supplies, there's actually, A, B, C, and D. You don't have a residual inventory of supplies because you only have that if you can't use the supplies on another in-scope federal program. So you actually say this is not applicable. You might actually have a federal interest because you spent money over $5,000 that you have to report, but you don't have a residual inventory of unused supplies. Also remember that if the federal money or federal government, let's say on H8D, gave you money for a mobile unit, it's not federally owned property, it's federally funded, right? And you have to continue to submit annual forms related to any federally funded fixed assets until the fair market value is less than $5,000. Because if you buy a mobile unit and you decide next year to sell it and you get $100,000 because that was the fair market value, you actually have to give that money back, because we have to, when it's federally funded at over $5,000, we actually have to return it if we dispose of an item. So keep that in the back of your mind. This same health center that was asking me the question about the Form 428 also actually told me that related to the H8F fund or grant money, that their grants management specialist actually told them that, hey, if you don't want to have to file the Form 428 and you don't want to have to submit, all of the information that you have to, schematics, the EID checklist, that additional budget justification related to your minor renovation, etc., just use your program income for your renovations and use your H8F money for salary expense, right? Because it's not federally funded if you don't charge it to a grant. And there's no prohibition against charging, building a building and expanding or, doing a renovation project with your program income. And it does actually reduce the federal administrative burden. And it's a very viable strategy and reasonable strategy for health centers. So keep that in the back of your mind. I was amazed that this, organization's project officer said it so very directly, but their point is valid, right? You don't have to use the grant money to do a renovation. If you want to do it, you could use your program income and not deal with the additional administrative burden that, we're talking about on this slide. All right. So I wanted to briefly, I keep showing this slide and I keep talking about it just mainly related to the fact that in 2019, the rules surrounding carrying over 330 grant funds changed. And HRSA in every single technical assistance call, since they began having them last year when COVID awards were made available to health centers, they've reiterated that, we do expect that there are going to be some health centers that receive provider relief funds, PPP, all of the grant money, that they might have to carry over their 330 grant, and it's completely acceptable, okay? So you can actually see when you're looking at this slide, both base and operational funding, in addition to different supplemental awards, can potentially get carried over. And so I want to just point that out because, you could get to the end of your grant year and potentially have a large carryover related to your 330 grant. A very common question that I'm receiving, and I know Jeff is as well, relates to profit, right? So we have a lot of health centers that have, they're not doing poorly financially because of all of the support. And, I've never seen a health center in my career. Jeff has worked with health centers longer. I've only worked with health centers for, 13 years, right? All I've done for the last 13 years is work with health centers. He's in it for much longer. And I've never seen a health center be penalized by HRSA for performing too poorly. When you think through like PPP loan and those economics needs certification, remember when you're looking through those, they're looking at second quarter, right, of last year and the third quarter. They're not asking you about, the fourth and later. And so that's another very common question that my health centers have been asking. Well, when I do this economic needs certification, I didn't have a profit for the period of time that they're asking. What happens later? I think those are very valid questions that I hope you're working with your financial statement auditor and your tax accountant on, just to make sure that someone looks at your application before you submit it and, works to identify areas where there might potentially be risk. The no cost extensions. So by now, I'm hoping that you understand that carryovers for your 330 grant, but no cost extensions for your, H8C D&E funds. You are supposed to make sure that you're doing this prior to the end of your project period. And so, if you think about it, how do I submit something and ask for an extension before I even know how much is going to be left? You're supposed to estimate it, right? And I just put these screen prints in here just in case it's helpful, because so you can see what the process looks like if you haven't yet done it for one of your grants. It's not too hard. You have to fill out the same, kind of information you have to do for a carryover request. It almost looks exactly the same. You need a cover letter and a 424. You have to help them to understand why are you asking for the extension. And then you guys are all going to be familiar with this form because this is the standard form 424A. All right. So those were some of the slides I just included so that you could reference them later. Let's actually begin to talk about time and effort, because this is by far the area where most health centers, where I see health centers have the biggest problem. So let's just talk about what's the requirement for documenting salary and wage expense that you're allocating to an award, okay? So we've underlined what's important. Charges to federal awards for salary and wages must be supported by a system of internal control which provides reasonable assurance that the charges are accurate, allowable, and properly allocated, okay? Now, with any of the grants where you can charge maintenance expenses for your health center, like maintain or increase capacity, right? You have to be able to document that your employees, what's important when you charge salary and wage expense. The employee isn't over the salary cap. You're not double dipping. You didn't charge it somewhere else. And it was for an in-scope activity, right? So allocating salary and wage expense to a 330 grant is actually kind of different than maybe allocating to a Ryan White grant that has to be restricted to a specific type of activity, or your ECT grant funding, right? But where do health centers go wrong? And this is where with the ARA funding, this is what we saw. Look at this last item, this last bullet point in the sentence that we underline. This is straight out of the Uniform Grants Guidance, and it says budget estimates alone do not qualify as support for charges to federal awards. What happens is you submitted an ECT budget and you were like, I think that dental assistant's going to work 40% on ECT grant and doing testing and 60% dental. You can't just allocate 40% of their salary to the grant. You have to track their actual time and allocate actual expense based off of actual hours worked. It can be hours, or this is where I talked about sometimes involving a practice management system report is appropriate, right? Is there something in your practice management system that you're documenting testing activities and personnel working on them, and you can use that to extrapolate hours allocable to, the ECT funding? That could be your system of internal controls, keeping, time and effort, a record of effort attributable to each award is by far the very best thing that I think you can use, the very best control to allocate salary and wage expense to a federal award. This next slide actually talks through, like, if you're going to maintain a personnel activity report, what does it have to do? What does it look like, right? So personnel activity reports are after the fact, based off of, some type of a report you can run out of your practice management system, or actual hours. Has to be actual, not budget. Has to be based on total activity, and it has to be certified as accurate from an employee or a supervisor with firsthand knowledge. But I believe HRSA has a definite preference for having the employee perform the certification. I was listening to an OIG auditor on a call the other day, and one of the things that OIG auditor actually said was that if an employee certified on their time that it was accurate, they wouldn't do any other work. Because if the employee said, I worked on ECT, they sign it and there's a certification statement that said, the time reported by me is accurate, the auditors won't even look at it. But what he said was, if the CFO is certifying to everyone's time, or if it looks like they budgeted 40% and allocated 40%, even if the employee was certifying, they're going to try to dig in and they're going to say, oh, employee, help me to understand how you actually worked 40%, because the very best certification that can be made is by the employee who knows what they were doing. Has to be prepared at least monthly and coincide with the pay period. We provided an example here. Always understand, like, we look at this certification statement. I actually took this example, it's slightly modified from a Department of Labor example for a timesheet. But, here, look at exactly what it says down here. It's actually at the bottom. It says, I certify that the distribution of effort shown represents the actual work performed by me. I would expect you have potentially ECT grant as one of the projects. And if you are allocating between the ECT grant and another grant, a certification statement like this and a time report that is by project would be fantastic support if the OIG ever came into your organization and looked at your supporting grant records. We're going to move on to our discussion about procurement. One of the things I just like to remind health centers is that Uniform Grants Guidance changed procurement for grantees in 2014 and for health centers. If I look at your policy and I don't see 5 definitions in your policy, so if I don't see micro purchase as a defined method of procurement, or this simplified acquisition threshold, and I don't see 3 methods of procurement in excess of the simplified threshold, I actually have this on the next slide, and I don't see a definition of small purchases, then I know your policy is not compliant with the Uniform Grants Guidance, because what do I know? The federal government says that there are 5 ways, 5 methods that a health center can use to allocate expenses to a grant, and there are only 5. So if you don't define the 5 methods by which you can procure, I know that your policy doesn't minimally meet the requirements that it needs to. So let me show you this next slide, because these are the 5 methods right across the top. These are the only 5 ways that you can procure with federal funds. So you can procure via a micro purchase. What I want you to remember is a micro purchase is any procurement up to $10,000. Okay. So from 0 to 10,000, that's a micro purchase. Small purchases. This is a defined method. I'm purchasing via a small purchase. That is $10,001 to $250,000. Above $250,000, you have to say, all right, I can use a sealed bid, a competitive proposal, or a sole source proposal. And you have to have supporting procedures that say, all right, when I'm spending over $250,000, here's the amount of work I perform. A small purchase, if you spend between, $10,000 and $250,000, the main thing to remember is that you have to have at least 2 quotes for the expense. You might have to maintain it once, right? But you have to have at least 2 quotes. You don't have to justify, why did I select Henry Schein over McKesson, but I had to have gotten a quote from both, and I have to have that in my hand so that if a federal auditor comes in, I can give that to them. Below 10,000, you pretty much don't have to do anything. Most common question I get when I talk through the methods of procurement with health centers is, well, can't I just purchase $9,999 over and over and over again? Well, yeah, you absolutely could, right? But I mean, it would, the pattern would become, apparent that you're trying to circumvent the procurement that should be in place. And so we don't recommend that you do that. But just remember, below 10,000, you don't have to do much. Between 10 and 250,000, keep 2 quotes. Above 250,000, you have to justify, why did I purchase from this vendor? And you have to do a whole slew of other things. You have to have contract language in, the contracts. Problems with contract language is actually one of the most common findings that's issued during site visits, because health centers don't do what they're supposed to be doing when they're contracting over 250, or when they're contracting for the sliding fee discount and providing required services through column 3 on that, Form 5A document, right? You're providing a service through a memorandum of understanding, and you don't have the right language in the contract. These next couple of slides are actually just an example that, this is, if you're spending over $250,000, this might be what your support for a procurement transaction actually looks like, right? So this might be how you document why you chose someone over $250,000, right? Because that's something that you actually should maintain. All of the health centers that I've worked to support for site visits over the last 2 years, they, one of the things that they're doing is they're asking for every procurement transaction over 250 or 20. They actually ask for over 250. And then they want to see some type of support like this. And I'm going to move on to the next slide that documents the procurement transaction and shows that you went through the right thought process. Now our very last slide related to procurement is actually, a lot of health centers kind of thought, oh, we're in a public health emergency. I don't have to go through, and do a sealed bid or competitive proposal. But I just want to remind you that, there were a couple procurement principles that were waived because of the public health emergency. And those related to geographic preferences, preference for smaller minority businesses, and women's business enterprises, but none others were. And so, having to get quotes and having to document a sole source and all that kind of stuff, like you still have to perform that documentation. And it's especially critical where I think some of our health centers are maybe going to have a problem is when they received HRSA funds and then actually went back and identified expenses back, dating to January 20th. And they didn't necessarily have time and effort potentially, or procurement support that was appropriate to charge those expenses to a federal award. So with that, I'm actually going to open it up for questions, and Jeff and I can actually take questions. I actually see one of the questions, Jeff, relates to provider relief funds. There was a question, how do you match revenue and expense when you may be using part of the grants? Oh, and it might actually be for me. How do you match revenue and expense when you may be using part of the grants for capital items? So very valid question, capital grant revenue, right? Typically, capital grant revenue on my income statements is below operating income. And so my operating grant revenue and operating expenses should net to zero. And if you had capital grant revenue, that would be below the line, and you would understand if there was a profit on, when you're looking at that income statement, you would recognize that it's attributable to the capital grant, because you shouldn't have a profit that is equal to more than the capital grant revenue.
Sometimes matching, especially with these PPP loans and provider relief funds, it's not going to be an exact one-to-one in a lot of cases, because you might have revenue in one year and expense in another year, you know, and things like that. So it is interesting how that works out. It's good question to ask.
Yes. There is that Q&A feature in Zoom, and we welcome any questions. Jeff, was there anything you wanted to add that you were thinking about while I've been talking about grants management?
Yeah, no, the one thing is you know, it's okay. I mean, I almost, it's not a technical type of comment, but just remember, if you're overwhelmed right now and you feel like this is a lot, I mean, you've just got a lot of information in the last hour and a half. And if it seems overwhelming to you, please understand that you're in a really big category with tons of people, because it's overwhelming for Catherin and I sometimes. I mean, we just like, oh my goodness, there's another rules on this. What's going on here? I mean, it does really have that effect. So I just want to encourage you to hang in there, stay with it. You know, reach out for help to us or other folks. There's lots of other people that can help you too, but reach out to folks to help and ask for thoughts on this and advice on this, because it really, there are so many moving parts right now. It is a little bit disheartening sometimes.
Yep, absolutely. Keep yourself informed as best you can. Keep going to training and ask questions, participate in, you know, CFO peer networks and, you know, other peer networks, ask other people what they're doing. And just double check if you have a question. Try to make sure that you're not receiving inconsistent guidance from, you know, anyone.
Yep.
All right.
Lindsay, was there anything you wanted to comment on?
Oh, I just wanted to say thank you. That was a lot of content in a short period of time. And I appreciate the remark that you made, Catherin. The Alliance does have what we call peer networking committees. We have one for financial officers. We have one if you are involved at all with any of the grant writing, grant management process. So I'll include my email in the chat box if you have questions, if you want to join one of those groups. It is a great way to talk to your colleagues around the state, ask what they're doing. Obviously, we have great partners like BKD as well. And I'll go ahead and put in a plug. They actually have a grants management boot camp that's coming up. Several of us here at the Alliance are participating. So I'm really looking forward to that. There are great other technical assistance opportunities out there. So please don't hesitate to take advantage of them and reach out if you need more information.
Yep, absolutely. We covered a lot of content today. The grants management boot camp. I mean, we do it over 4 days, right? 4 days of 4-hour sessions. And I mean, grants management, there is no easy button, right? And so, yes. And then Lindsay, there's a question about the slides.
Yes, I was actually going to ask you all, is it okay if we share the slides with the attendees today?
Absolutely. A PDF version is absolutely okay.
Great. Well, we will make sure we get that sent out. We'll also have a recording of today's webinar, and then we'll also be including that satisfaction survey. So please be on the lookout for those emails.
Awesome.
Anything else, Catherin and Jeff, before we close out?
No, just thank you for the opportunity to talk through these this important information with everyone today.
Great. Well, thank you. Thanks to everyone for joining us today. We appreciate your time.
Looking forward to Friday for the cost report training. So hopefully that'll be just as exciting, hopefully.
Yes. All right. Thank you all. Have a good day.
All right. Thank you.
Bye.
See you later. Bye-bye.
Bye.